Risk measurement is a fundamental component of portfolio management because it enables institutions to identify, monitor, and control exposures that could threaten financial objectives. Different organizations face different types of risks, causing them to adopt risk measures tailored to their specific activities, liabilities, regulatory requirements, and leverage levels. Risk measures such as value at risk, VAR, sensitivity analysis, scenario analysis, active share, maximum drawdown, and surplus at risk provide insights into potential losses and portfolio vulnerabilities. Effective risk management requires combining multiple measures because no single metric captures all dimensions of risk. Consequently, organizations develop comprehensive frameworks that integrate quantitative analysis with strategic decision-making. Banks typically employ a wide range of risk measures because they are exposed to market risk, credit risk, liquidity risk, leverage risk, and asset-liability mismatches. Their risk management processes often focus on the volatility of economic capital, portfolio VAR, duration and convexity of fixed income holdings, and stress testing under adverse market conditions. Because banks frequently operate with significant leverage, small changes in market conditions can have substantial effects on capital adequacy. Regulators also require banks to maintain robust risk measurement systems to ensure financial stability. As a result, banks use risk metrics not only to protect profitability but also to satisfy regulatory and capital management requirements. Asset managers generally focus on measuring portfolio volatility and benchmark relative performance. Their primary objective is to generate attractive returns while controlling the risk of losses relative to client expectations and investment mandates. Risk measures commonly used by asset managers include active risk, tracking error, information ratio, active share, and probability distributions of returns. Active share measures the difference between portfolio holdings and benchmark weights, providing insight into the degree of active management being employed. These metrics help managers evaluate portfolio construction decisions, monitor risk exposures, and communicate investment performance to clients. Effective risk measurement is therefore central to successful active portfolio management. Pension funds have unique risk management challenges because their investment portfolios must support future benefit obligations. Consequently, pension fund managers focus heavily on asset liability management and surplus volatility. Surplus represents the difference between pension assets and pension liabilities, and maintaining a stable surplus is critical to long-term plan sustainability. Risk measures such as surplus at risk evaluate the probability and magnitude of funding shortfalls under adverse market conditions. Pension managers also analyze interest rate sensitivity, liability duration, and scenario outcomes that could affect funded status. These measures help ensure that investment strategies remain aligned with future obligations and minimize the likelihood of significant funding deficits. Insurance companies use risk measures that reflect both investment risks and insurance liabilities. Property and casualty insurers are particularly concerned with economic capital, factor sensitivities, and stress scenarios that combine market shocks with insurance losses. Life insurance companies focus on the risks affecting assets that support long-term obligations such as annuity payments. They closely monitor asset-liability mismatches, market risk exposures, and scenarios that could significantly reduce surplus. Because insurers must meet contractual obligations over extended periods, they rely heavily on scenario analysis and stress testing to assess resilience under adverse conditions. These specialized risk measures support prudent capital management and long-term solvency. Organizations frequently impose constraints to manage market risk and prevent excessive exposures. Risk budgeting is a structured process that begins by determining an acceptable level of total risk and then allocating that risk across strategies, business units, or asset classes. This approach ensures that risk-taking remains consistent with organizational objectives and capital resources. Position limits are another common constraint and restrict exposure to specific securities, sectors, asset classes, countries, or currencies. These limits promote diversification and reduce concentration risk. By allocating risk intentionally and imposing exposure constraints, firms can balance return objectives with prudent risk management practices. Additional risk controls include scenario limits and stop-loss limits. Scenario limits establish maximum acceptable losses under specified market events, requiring portfolio adjustments if projected losses exceed predetermined thresholds. These constraints help firms prepare for adverse economic, financial, or geopolitical developments. Stop-loss limits require positions to be reduced, hedged, or closed when losses surpass a specified amount within a defined period. Some stop-loss programs use dynamic hedging strategies, such as portfolio insurance, to protect against severe declines. These controls are particularly valuable during periods of heightened market volatility because they establish clear rules for managing losses and preserving capital under stressful conditions. Risk measures also play a critical role in capital allocation decisions. Firms must determine how to allocate limited capital among competing business activities while considering both expected returns and associated risks. A purely return-maximizing approach may expose the organization to unacceptable levels of risk. Therefore, risk-adjusted allocation frameworks incorporate measures such as VaR, economic capital, and risk budgets when distributing capital across business units. By assigning risk limits and evaluating expected returns relative to risk exposures, firms can identify more efficient uses of capital. This process improves strategic decision-making and supports sustainable long-term value creation while maintaining acceptable overall risk levels.